On this episode of Build Your Wealth Muscle, episode 111, we'll go into and you will learn tax planning for the new year for 2026. We'll dive into prioritizing entity planning. We'll go into the cash needed for tax payments. And we'll wrap it up with going over some 2025 and 2026 retirement account planning. As always, I hope that this is helpful. And if so, please do us a favor and share it with a friend. Thank you and enjoy the show. Welcome to Build Your Wealth Muscle, a podcast dedicated to helping fitness entrepreneurs build wealth by saving taxes and growing their money. Each episode will break down different strategies in the areas of business, tax, and retirement planning specifically for your coaching business. Disclaimer, the topics covered in this podcast are for educational purposes only. This is not advice for your specific situation. Please consult a qualified financial or tax professional before making any changes to your financial or tax situation. Now here's your host, certified financial planner and tax advisor, Pat Darby. Hey, how's it going, everybody? Welcome back to Build Your Wealth Muscle. It's been, I think, about 18 months since our last episode at June of 2024. To give a little background, we were fortunate enough to have a lot of growth, so I had to spend more time focusing on building the operations, building the team, and had less time to do some of the educational content. So we built the team, and I'm able to, for 2026, when you'll be hearing this, get back to providing some educational content. So anyway, for those that are new, welcome. For those that are returning, thank you for coming back after a long break. As a reminder, we do have like two formats of the show. Solo episodes like today, where it's just me giving you information, and that allows me to go a lot deeper into the rules and how you can apply it for your business. And then we have episodes with guests where they're going to be an expert in different areas. Could be lending, legal, marketing. They might be a colleague of yours in a different type of online space, online business space. So today, what I really wanted to get into is, now that it's the new year, it's 2026 when this is going to be released. I'm recording it actually towards the end of 2025. The idea of tax planning, and there's episodes that I'll do again on this because it's an important reiteration, that tax planning is just that. It requires some forethought. And so along with that forethought, it's also like a cash allotment that you need, because a lot of the better strategies, it does require you to have cash. So now throughout the course of the year and in prior episodes, we go into like how you can write off the things that you're using in your business anyway. That's also obviously helpful. But I want to kind of get into some of the things for 2026, or just in the beginning of any year. They can kind of start planning through what you're going to do to save taxes. And a lot of that's going to come down to budgeting, because as a hypothetical example, and we'll certainly talk about this in a few minutes, if you're going to do a retirement plan, you need to have the cash to put into that retirement plan to get the tax deduction. So a lot of those things, if you wait till the last minute to do it, you might say, okay, yeah, I really want to max out my 1K or whatever the case may be. But you may not have the cash to do it. Now, there's some that allow you to leverage it, like a vehicle and things like that. But I'm not a huge fan of buying things that you don't need. Now, again, if you need a vehicle, there's not necessarily a timing strategy in that. You can do it towards the end of the year as well. So I'm trying to like plant the seeds of what you should think about throughout the course of the year in this episode. But that being said, a vehicle, you could only have the down payment and then get the full tax deduction. But for example, like if in the 401k, you can't put down 10% and get leverage to max out your 401k. So you need to have the cash available. Now there's timing on that. And again, we'll get into that. But again, this episode's less about getting into the weeds on a specific strategy, but more opening the door to like, this is what you should think about for 2026. And can you allocate some money towards it so that you can execute it properly? So that's the first thing. Do you have a budget? Do you have in your business and in your personal life money that you set aside to reinvest? Doesn't matter what that number is. We'll kind of go through some things that might get you thinking, okay, well, that one particular one is important to me. I need to set money aside for that. And again, now hopefully we're giving you 12 months to think about it and put the money together, or prioritize it. If your business is highly successful and you have the money, start to prioritize, okay, 100,000 will be for retirement plans versus 100,000 to do X, Y, or Z. So the first thing is, let's talk about the entity that you're working out of. Are you a sole proprietorship, or do you already have an LLC? Now, you see on prior episodes I've had, but to reiterate, you don't need an LLC to do tax strategies. Virtually everything that is deductible for an LLC owner is deductible for someone who is working out of a sole proprietorship. The main reason we like LLCs from a tax perspective, because LLCs have legal protection. I'm not a lawyer, full disclaimer, this is not legal advice, but the LLC is a gateway into being able to use the S corporation. And many tax people, if you follow other podcasts or social media, or my own social media, which is at the Pat Darby on Instagram and TikTok, you need the LLC to get into the S corporation. So that's why at the beginning of the year, if you had a very good 2025, it might be time to quickly get an LLC so that a tax advisor can come in there and make the entire business an S corporation. And that'll save you taxes on the self-employment tax side. So again, to reiterate, you don't need an LLC if you're still in the phase where you're trying to really cut costs wherever you can. You don't need it to be able to write off all the things. Like if your podcasting equipment, travel, all of that, you don't need the LLC for that. But again, if you're at the point where you're making over 50, 60K in net profit, in my opinion, it makes sense to be an LLC, because you're going to want to talk to somebody about being an S corporation, and that's going to be the foundation they'll need. Along the similar lines of the business entity, you want to consider whether or not you have your estate plan in order. Again, that's not necessarily tax advice, but you want things to be smooth for the next generation and all your beneficiaries if something happens to you. So I'm just mostly talking about this from a budgetary standpoint, is because if you sit down with someone who's going to holistically look at your business and your finances, it's a good chance they're going to want to bring in who owns all this. Like if you have a business and a rental property, who owns that? Is it you, your personal name, your social security number, or is it a revocable living trust? So that God forbid something happens to you early, maybe you have young kids, whatever the case may be, those properties go through a much simplified process through your trust versus a more time-consuming and slower and public process of the probate courts. So again, that's not necessarily a tax strategy as much as it is to sit down with a lawyer is probably going to cost you $3,000 to $5,000. Maybe you can find some a little bit less than that, and depending on where you go, you could certainly find them more expensive than that too. But that's typically what I've seen my clients paying in that $3,000 to $5,000. If you can get one closer to $2,000, that could be good too. My only recommendation is I would probably try to find somebody that their specialty is in estate planning, rather than finding a friend of yours that's a lawyer and ask them to do your estate plan. So that's the one caveat. But again, it's just more from a budgeting standpoint, because as you're building the LLC, as you're getting the S corp, if one of the tax strategies you're considering for 2026 is buying a rental property, again, having a trust that could own that property makes sense, because you can go and do it all later, but then you're potentially having duplicate costs, because they're going to title your rental property into your trust. And then if you buy another one, if you buy something, they're going to title it in your name, and then you're going to have to pay your lawyer to retitle it into the trust. So the more things you own and you're retitling later, it could get more expensive. But really the main purpose of doing the estate plan is to make sure that you have everything flow the way you want it to. God forbid something happens to you and potentially you have younger kids. So along the same lines of that, your travel for 2026. As you may know from prior episodes, business travel is a write-off. So the flights, the hotels, the meals, as long as the primary purpose is business. So you might start to plan out like, what is my travel going to be this year? Because again, you have to have the cash. You can put it on a credit card, of course, but like You want to have the cash to like book the flights, book the hotels, but you want to also get creative because part of being a business owner, you're going to want to have board meetings and you're going to want to fill out meeting minutes. That is helpful because of more of the legal side. Again, get with a lawyer, but they're going to want you to have annual meeting minutes. So it's important, in my opinion, to start thinking about like if you're going to be going somewhere anyway, maybe it's something with family, to start planning ahead. If let's say you have a trip coming up in May, which as I'm recording this, it's like 5 months from now, how can you do your best to make that trip primarily business related? So maybe you see clients, maybe you see vendors, maybe you see prospective clients, maybe you have a formal board meeting and fill out your meeting minutes with some of your family and maybe some trusted centers of influence in your life. Maybe they're marketing people and you're having a strategic meeting on what you're going to do for the second half of 2026. So again, just from a budgetary perspective, start thinking through that because you probably have travel that is on the calendar. Maybe it's for weddings, maybe it's for birthday parties, anniversaries, whatever it is. Start plotting that out and say, how can I build that into a business trip? What clients do I have in the area? What vendors? If you're an influencer, like what photographers could I schedule a day of shooting with? Things like that. So you want to start planning ahead. What are all the business trips and how can you fit that into the budget? And just as a reminder, when we're talking about the travel, entertainment is still not deductible. So the most simplistic example of that is you take a client to a football game. The tickets are not a write-off, but what you eat at the stadium, burgers, beers, whatever, that is a write-off. Now, granted, meals are only 50%, but the tickets themselves are 0%. So just budget that in there too, because that tends to be a sticker shock, for lack of a better term, for clients in that they spend thousands of dollars and it might be totally legitimate. You're taking out clients, but it's not a write-off. Like, especially think of the big corporations that get suites at these top stadiums, they're paying multi six figures. That portion of it is not a write-off. The entertainment side, golfing, things like that, that all went away years ago. So just bear that in mind. Because again, if you're spending tens of thousands of dollars in entertainment, and again, it might be legitimate and you have to keep doing it because it's bringing you more revenue, bringing you new clients, things like that. But just be aware those dollars are not actually lowering your tax bill. I hadn't planned on talking about this in my notes, but this made me just think of it. Along the same lines of things that are not really deductible or you have to plan through it are client gifts. Because client gifts, I believe, I should have looked this up before, but it's about $25 is the write-off for client gifts. So if you give somebody $1,000 prize or whatever the case may be, if you want to write it off, you have to 1099 that and basically push the tax liability to them. A lot of business owners that I work with, they don't want to do that because it's like that wasn't the purpose of that prize, but that's something to think about too. So again, just gifts, prizes, and entertainment for clients, those are not deductible. Again, the gifts kind of are, but not really, or not materially, I should say. So if you're giving people 4-figure gifts and above, you're going to feel like that $25 is nothing. And you'd probably be right. So getting into more of like the cash flows again, let's talk about some of the tax strategies that I really like, which are more of like the retirement side. Because again, we have the wealth management company. So I always try to think with that wealth management side. It's like, okay, you make all this profit in your business. What are you doing to feed future you? And that's another reason why, again, I don't try to always be negative on what people try to do with the expensive, heavy vehicles. But if you need the new vehicle, then that's great. But if you're just buying it for the write-off, I'm not a huge fan because it's a depreciating piece of expense. I don't want to call it an asset, but it's depreciating. And so that's one of the things I don't like about it. But now we're talking about retirement vehicles. So you could do an IRA or a Roth IRA. That's $7,500 for 2026. And if you're listening to this before April of 2026, you can still go back and put in 2025's contributions. So again, in that scenario, start thinking through how much money you have. I would prioritize 2025 if you haven't done that, because you have until April of 2027 to put $2026 in. So right now that we're in the new year, you can start, all right, what's still available to me from 2025 to do. And the IRA, the Roth IRA, you can't do both, but you could do one or the other or a combination. But you have a $7,000 limit last year, 2025, $7,500 limit in 2026. If you're under 50, you get an extra $1,000 if you're over 50. Same with the HSA. You can do it's $4,400 in 2026. I think it's $4,350 in 2025. And then you can basically double that for a family. So again, same thing. If you haven't done 2025 yet, you can go back and do it. You do need to have an HSA eligible health insurance plan. And so that would be part of whether or not you can actually do this or not. Same thing with a solo 401k. Talk to a plan provider if you're trying to do something for 2025, because the rules get pretty complicated on what you can and can't do if you haven't established a plan in 2025. But for 2026, this is another one that I would highly encourage you to consider planning for, because if you want to max it out, you can put up to $72,000 in there. So that's a big one, because depending on where you live, if you're going to do that pre-tax, if you're in California, New York, New Jersey, those can be pretty substantial write-offs if you're going to flip it and go pre-tax. But that being said, you need to have the $72K available to put in. And you need to make sure if you're an S-Corp owner, you have enough B2 wages to cover it, stuff like that. So typically you don't want to just start deciding to put $72,000 or something less than that towards the end of the year. You want to be like, all right, this is my plan, and start chipping away at it each month, or start putting the money away mentally or physically. Same thing like right now, the main thing to consider as well for tax filing, you're going to have your quarterly estimates. January is going to be the first one for the year, but it's for 2025. January 15th is 2025's Q4. April, from a cash flow perspective, is probably the most important thing to wrap your head around, because it can really sneak up on you. Now, I'll do full episodes on what quarterly payments are due so that we can really dive deep into this. But just so you're aware from a cash flow perspective, because that's really the theme of today, is the cash flowing, is to really get a handle on the fact that when you're working with your CPA or your tax advisor, there's kind of two numbers that you need to consider when you talk about the quarterly estimates. It's how much you need to pay to avoid the underpayment penalty, which is a calculation that the IRS gives you. The accounting software is just spitting out a number. When they did your 2024 tax return, spits out a number calculating what you need to pay for the 2025 year to avoid an underpayment penalty. So maybe they have that set up for you on auto pay. And it's like, okay, it just has a hypothetical scenario. Let's say it calculates that you need to pay $10,000 every quarter for a total of 40. So if that's on auto pay, or if you're doing it manually to make sure that you have the cash towards the end of the year. So again, January 15th, you make your fourth $10,000 payment. You've now paid $40,000. But if your business is doing substantially better in 2025 than it did in 2024, in a hypothetical scenario, maybe you actually owe 60. Now, because the accounting software was using that formula, you have no underpayment penalties. But you do have that difference between the 40 you paid and the 60 you owe. And that is due April 15th. So in that scenario, you owe 20 grand for 2025 on April 15th. What makes that complicated is now the software is starting over again and saying, okay, again, I'm going to keep the math simple. You owed 60, so divide that by 4. Now you owe 15,000 each quarter. So it's going to want the first portion of that 60,000, which is the 15. You're going to owe that on April 15th as well. So in that scenario, that hypothetical scenario, you owed the balance from 2025 of 20 and the first allocation of 2026 of 15. So 35,000 is due to the IRS on April 15th. Again, that's broken into the balance due from 2025 and Q1 of 2026. Because you can file for an extension on the paperwork. That will push you out to October, which is very common. And quite frankly, we recommend it because the audit rates are lower, but there's no such thing as an extension on the payment. So just keep that in mind as that general theme of like the cash that you're going to need to have available as a business owner throughout the course of 2026 and any year really, but obviously this is to keep the present time, 2026, is that April 15th can get very financially tight for business owners because it's an overlap of the end of 2025 and the kickoff of payments for 2026. Keep that in mind as well. And then the last thing to get into from a timing perspective is Roth conversions. So what is a Roth conversion? As real simple, and again, I could do full episodes on this, and quite frankly, I probably will. A Roth conversion is basically taking money out of your traditional IRA or your pre-tax 401k and rolling it to the post-tax world of the Roth IRA. The reason you would do that would be if you're strategically saying, like, the reason you do a Roth conversion is art more than science, in that you're saying, okay, my federal bracket right now is X. I'm going to make a bet with my money that this is a lower rate than it will be when I'm in retirement. Because in retirement, your pre-tax dollars, like IRAs and 401ks, pre-tax 401ks to be clear, they will eventually get required distributions, meaning the IRS is basically saying, you had a good run. We gave you a write-off when you were in your 20s, 30s, 40s, and 50s to put this money in. Now you're 70-something years old. They keep moving that number right now. It's about 75. You're 75 years old. We need you to start liquidating. And that's exactly what it is. It's called a required minimum distribution. And there's a calculation that they'll give you, and they'll say, okay, this is the amount you have to pull out of your account, and it's fully taxable. And you have no clue what the tax rate will be that year because it's based on your regular income bracket. So if you're making $100K a year and then it's going to force you to pull $1K out of the IRA, your now taxable income that year is $170. So the reason people do Roth conversions is to get out in front of that. Maybe they had a slow year in their business. Maybe you went out and hired a bunch of team members and they haven't ramped up yet. And so your taxable income is way lower projected for 2026. You might strategically move money out of an IRA and into a Roth IRA, but you're going to owe taxes on that money. The advantage there is you might get hit with underpayment penalties, but that payment's not due until April of 2027. So it gives you plenty of cash flow timing to say, all right, maybe I'm going to move DK or 100K out of my IRA and into my Roth, but now I have the next 15 months to plan for that big tax bill. Now you should pay right away on the quarterly estimate, but take that out of it if you want, because there might be some underpayment penalties for not doing so. But from a strategy perspective, that might be of interest to you, especially if you're somebody who's into self-directing. Like when you're sitting there deciding like, well, I want to buy a rental property in my IRA. It's probable that the person is going to recommend consider doing that in a Roth IRA, just because then you don't have to worry about the timing in the future. Because if you have, I didn't want to go down this rabbit hole, but just to give you the reason I'm saying this, when you have like a Charles Schwab investment account that's in your IRA, when you need to do either a Roth conversion or your required distributions when you're in your 70s, it's really simple because the math is like completely cut and dry. It runs the equation based on what was your balance on 12/31 and then multiplies it by the percentage based on your date of birth. And so it's really simple to spit out a number. Now, if you have that same scenario with a rental property, you have to go out and pay for the valuation because nobody knows like what was it valued at on 12/31. So you have to pay for that valuation. And that's why it can get a little bit cumbersome because then you're converting a percentage of a rental property. And if you plan ahead and start converting stocks and cash to Roth, then if you went out and bought a rental property, it's 100% owned by your Roth instead of your traditional IRA, you never have to worry about it because inside of a Roth, they don't have required distributions. Mainly because at the moment, the IRS is like, well, we don't get anything anyway. They tax the money to go in. Pulling the money out, they don't get anything other than the fact that now the money's in the taxable world. So a Roth conversion is something I would keep on the radar as well, especially for younger people, because the financial planning industry, in my opinion, has really let down younger people on these because these Roth conversions get popularized for people who are retirees. And in my opinion, that sort of misses the point, because you can take little chunks along the way for 30 years versus waiting until you're in your late 60s, because that's typically when it's advised by the financial planning community. Is like, okay, you're retired, maybe your income has come crashing down because you were maybe making multi six figures, you were running your business, and now you sold the business and you don't have much income. Maybe you have a little bit of dividend income from your portfolio and also your Social Security benefits, things like that. So they're like, all right, now you're in a much lower bracket. Let's start doing it. But you have a very tight window to do it versus like, the ebbs and flows as a business owner. You could have a really good year, then the following year could be a growth year and you're spending business development, building a team, doing X, Y, and Z. And then even though your revenue is still high, your expenses could have skyrocketed as well, leaving a much smaller net profit. If you have the cash reserves, that's a quote unquote investment, is pushing those dollars out of pre-tax accounts where you got a big tax deduction in a prior year and moving those dollars in a low tax year. So again, I think those are super valuable to do that early on when you're younger than waiting to the end when you have to do like really big Roth conversions. And again, the other issue with that is who knows where tax rates will be in 20, 30, 40 years. Anyway, that was the main things I wanted to go over today. But from a high level, is just start planning ahead what cash you have in your business that you want to set aside for strategic planning and to lower your tax liabilities. And again, just to fully reiterate it, most of the strategies you see require cash. It's very difficult when you sit down with a tax advisor and say, I want to save a lot of taxes, but you don't have much cash flow to put the money places. That's why people end up backdooring into vehicles and stuff like that, because it's one of the few things where you can use leverage and just put a small down payment down and get the full write-off. But a lot of times those business owners wouldn't necessarily be attracted to that strategy if they had other options because they had the cash reserves to deploy. So anyway, thank you again for those listening today. I appreciate it. Thank you for coming back. If you're brand new, again, welcome. We're going to get back to weekly. And then if you know anybody that wants to be a guest, because we are trying to fill up the guest lineup as well, I'm also trying to figure out some of the tech to better do it in person. I tried to use this platform before and it wasn't as helpful, but I think they've made some upgrades in the 18 months I haven't been here. But anyway, hope your 2026 is off to an awesome start, and I'll see you next week. Thank you for joining us this week on Build Your Wealth Muscle. The links mentioned in this episode are available in the show notes. For video clips and more information on tax and retirement strategies for fitness entrepreneurs, please follow my Instagram @ThePatDarby. If you found value in this episode, please do us a favor and share with a friend. If you tag me, that'd be appreciated also. Lastly, for help implementing any of the topics discussed, please book a call. The link is also in the show notes. Thank you again for listening and have a great day.